Hello, everybody, and welcome back to another installment of our Southern California housing market update. My name is Stephen Meade with Domicile real estate for people who love houses. And this is our update for, I can't even believe this, February 1st, 2022. And I kind of titled this Dare to Ask Why, because I've been noticing kind of a lot of something on Facebook, and I think it's important to address this. So one of the things I'm seeing is right now a lot of agents that I know are out there putting on Facebook kind of their advice on the market and what they think is going on. And I actually agree with what most of them are saying, but I think it's really important to dare to ask why. I don't think it's good enough just to trust someone's gut, even if their gut has a pretty good track record. I think, asking people to explain really where their kind of reasoning is coming from tells you a lot about really how much they know. And I think as a consumer, it's important to ask those kind of why type questions. Something else that I wanted to go over is that frequently with these market update videos, we actually publish these live to Facebook. So we live stream them. So when you're watching, if you're watching this on YouTube, we don't do multiple takes for these. This is all done in one setting right at the get-go. So I don't want to waste any time. I kind of want to get into this because you might be seeing a lot of messaging about the housing market and kind of a get in while you still can type of a message. And I'm not even saying that I disagree with that. In fact, I actually agree with that right now. But I want to go through and I want to explain to you why that is and where that advice is coming from. So let's go ahead and get into those stats. Okay. So the first thing I want to talk about is something that you are all probably acutely aware of, but let's put some numbers to it. And that is active listings in the marketplace. And as always, just a reminder for everyone here, we do this based on Los Angeles and Orange counties. That's sort of our proxy for Southern California. We actually have a lot of buyers and sellers who kind of go back and forth between these two areas, so they're contiguous. And then we like to divide our statistics, or many of them, into under $1 million and $1 to $2 million. And sometimes these categories move the same, but sometimes they move differently. And probably the biggest thing you notice here is just how much lower our inventory is right now versus last year. But it's not all terrible news, right? So at the outset, the problem that we have is we are significantly below the amount of inventory that we had. So I think, what is it? Last year we were at a little over 5,000, and this year we're like 3,300. That's a really significant drop, under $1 million. But there's something good going on here, and I want to point out the shape here. So what you notice is last year, the inventory kind of bumped right about the middle of January, and then it kind of just steadily fell, and things didn't really get much better until May. This year, it bumped, and then it's just been flat. So the bad news is inventory is not really growing, which is what we'd like to see happen, and it's significantly less than it was last year. But it's not eroding in quite the same way that it did last year either. And I think actually the interest rates have something to do with that. Coming back here to our new listings, right? This is an interesting chart because this is one of those ways in which we see that the under $1 million market is different than the $1 to $2 million market. And I have a little bit of a theory on that. So, just to summarize, you guys can read, but this is looking at everything that came onto the market in the last 2 weeks. How many units are we seeing? What's that rate of things hitting the market? And, we are significantly below where we were last year in our under $1 million category. It kind of jumped up, and then it really has sort of hit a little bit of a wall. And I'm going to be really curious to see if that kind of gets up here through the spring like it did last year, and then wanes as we head into the fall, or if it's going to really just kind of stick at this level. But if you look down here at our $1 to $2 million category, that is actually the same level as last year. And that's a clue, right? That is a clue that the people who are selling their house between $1 and $2 million are different than the people selling their homes under 1 million. And I have a little bit of a theory that I'm going to go over when we're talking about these sellers, 1 million versus the 1.2 million sellers. I think many of the $1.2 million sellers are either downsizing or they are going out of state. And I think the problem with the under $1 million sellers is those people are primarily move-up buyers. And that move-up buyer market, I think, is being significantly impacted by both interest rates and by the lack of availability of houses in general. And I think it goes like this. If you bought a starter home for, let's say, $500,000 at some point in the last 4 years, and you've now decided you'd like a bigger home, the great news is your home has gone up in value by a lot, and you now have a big down payment. Yay. The bad news is, what are you going to buy, and do you have a lot of confidence? And because interest rates have crept up a little, you're going to pay more for that house than you would in terms of a payment just even 6 months or a year ago. So I think that that is stunting the number of these under $1 million listings coming on the market. I think a lot of would-be move-up buyers are afraid of moving up. And I think that that's going to stunt those new listings. And that's really going to help bolster demand and keep that supply low for the houses. Okay, so that's where we are. But here's where we are in new escrows, right? And, you know, I think a big question a lot of people have is, are interest rates affecting demand like we've seen? And what we're seeing here is that these new escrows, they also rebounded. They're continuing to go up a little bit, which is interesting. That's not what we really saw last year. We saw them kind of hit and then just plateau and then erode into the fall, which is a pretty normal reaction. Very similar thing here in our 1 to 2 million. I think the shape of this curve might be a little bit different this year. I've talked about us being supply constrained, and I think that is still the case, meaning more homes would be going into escrow if there were more homes available for buyers to buy. I don't think, at least right now, that the interest rates going up has really affected demand or that supply-demand balance in the way that a lot of people, especially a lot of would-be buyers, would have hoped for. I'm just not seeing that, but not by the shape of this curve, not by any of it. It says that yes, buyers are concerned about those higher interest rates, but it's not really sucking a bunch of people out of the market, which was, I think, the fear. What else is interesting is in this 1 to 2 million category, these buyers seem to be a little bit more resilient. We are, in fact, at almost exactly the same level as we were last year. So even though our supply is better for 1 to 2 million, so is our demand. Kind of another clue that demand is actually very closely related to supply, meaning we're just not seeing as many homes selling and going into escrow because there just aren't enough there. If we look at our absorption rate, you know, historically speaking, generally the absorption rate has been higher on under $1 million listings than 1 to 2. One reason for that is that $1 to $2 million listings are less likely to go through, meaning, you know, if a house for $600,000 comes on the market, it is probably a 95% plus chance that that home will result in that listing will close at some point and sell. 1 to 2 million has been a little bit lower than that. So we typically see that split. But what I find interesting here is that we are right back above around this 90% level. You know, if anything, what the interest rates have done is they have prevented the market from being dramatically worse than it was last spring, even though we have much lower inventory. They've kind of allowed it to sort of remain the same. And again, we're seeing in that 1 to 2 million around the same level of absorption that we saw last year around this time. Now, what's interesting is, just a reminder of everybody, absorption rate is a very simple calculation. We look at all the homes that came onto the market, and then we look at how many went into escrow during the same time period. And that's basically that ratio we're looking at is, if 100 homes came on the market and your absorption rate was 90%, 90 homes went into escrow that week. It doesn't say which homes went into escrow, and that can be important sometimes, and why we have another measurement for that. Now, if you look at our closed prices, you might think that this is really great news, but remember something. These prices are 4 to 6 weeks in the past. Where were we in time 4 to 6 weeks ago? Well, we were in the middle of December, which is probably the softest market of the year. I've often joked that that period between Thanksgiving and New Year's is my favorite time to go home shopping Really, it's when demand is the easiest. So you're kind of seeing the results really of kind of that December market here. I think that this is a little bit of an illusion. I think the market, the prices today, like this second, are higher than this. And actually, if you kind of notice, things always seem to dip a little bit around that time period too, or stay pretty flat. Now, this is our secondary measurement, and I want to talk about this just for a second. So I mentioned a second ago that we're not just looking to track how many homes went into escrow versus the ones that came versus the number that came out of the market. We want to know which houses are coming into escrow. And we can measure that by looking at how many of the homes that came on the market in the last 14 days are still available. So that's what this chart measures. And it's a little bit more of a measurement of which houses are going into escrow. Is it the recent listings or the older listings? And one of the things that you look at here, and this is really important, is this graph, especially for our 1 to 2 million, this shows that that market is even more slanted towards homes that are just coming onto the market. And even when you look down here, look at where we are versus the fall. You know, the fall saw people taking a look at some of those older listings, right? And those were the ones that were going into escrow. But look at where we are right now. This means that as soon as these homes come out of the market, they are getting snatched up by current buyers, implying that buyers simply don't have a really deep bench of older listings to go back and look at right now. And that's true, they don't. Here we have our close to list ratio. And I think this is another one. We are looking back 4 to 6 weeks, but understand how much different this looks than last year. Last year, where were we? We were right around 100% or 101% for these closings in our under 1 million category. Right now, we're at 103%, 104 for our 1 to 2 million. This shows that sellers, I think, really want to induce bidding wars on their homes. I think part of this is a strong market, but the other part is really just a shift in strategy of sellers. I think when markets are weak, sellers are very they're very afraid of leaving money on the table, right? So they want to list as high as possible. They want to try to hold and grab on to all that equity that they can when they sell. I think in this market, some of these sellers are more likely to say, I want to create a bidding war and watch it go to the stratosphere. And I'm not so afraid of underselling by putting my house low. I know people will bid it up. So I think it's really part of this is a difference in strategy that we're seeing in the market. What does this mean if you're a buyer, right? If you're a buyer, it means that, in the past, if a buyer told me their price range was up to 750,000, we would look for everything that was priced under 800,000, knowing that some of those homes are going to be overpriced. Today, it's a little bit different. If a buyer tells me their cap is 750, I'm a little afraid to send them anything that's over 725, right? Because we know there's going to be a pretty significant amount of bid up on these houses on average. And that's a very different philosophy than we saw just a couple of years ago in strategy in the market. Here's another sign really of kind of letting you know that this market is a very competitive market. And I don't think this market's going to get any better anytime soon. Look at our days on market. Here we are under 1 million. I mean, we are right back down at 20 days, right? We didn't see 20 days until the middle of March last year. And look at where we are for our 1 to 2 million. We didn't see that low 20 days until the end of March last year. In a lot of ways, this market is accelerating in the speed that it operates. And I know that even sounds crazy to say, right? Because last year it felt like homes went on the market on a Thursday and they were in escrow by Saturday. Well, I think we're seeing it's even faster than that now. There really isn't a chance for listings to stay in the market for very long right now. If you look at our affordability, right? I mean, we're still hovering around that 120% level looking back to June of 2018. Like I said, I think this number might actually be a little bit higher. I think prices are trending a little bit more upward than this because we have extremely low inventory. If you look here at our prevailing mortgage rates, we saw a very, very big increase, and we might be seeing a little bit of leveling. I've kind of got my fingers crossed, give the market a chance to catch up a little bit. So I put in here, I want to tell you the reasons why I think that in the short term, things are not going to get much better for you if you're a buyer. And if you are a seller buying something else, this really applies to you too, right? Because if you are moving up, you are buying something more expensive. So I think that what we've got going on with inflation, I don't think we're going to see a return to sub 3% interest rates in the immediate future. Not for a while. I won't say it's impossible, but it doesn't seem very likely. And we have a perennial supply problem here in Southern California. There are a lot of reasons for this. We could do a whole video just on the reasons, right? Is it regulations? Is it lack of building land? Is it NIMBY groups? It's really all of these things, right? Is it an aversion to density? Is it people in love with the single family home format? It is all of these things, right? And the problem that I see is I don't see anything that's going to correct that anytime soon. And even worse, we have something called reactive supply. And one of the things that people like to talk about when they talk about real estate statistics to make things easier is they pretend that one variable is going to change and none of the other variables are going to be affected, right? So like, here's a good example. If interest rates go up, what would you expect to happen to demand for houses, right? This means houses get more expensive. Well, you would expect demand to go down. And that may very well happen, right? Like that's a pretty safe assumption. But how is supply affected if interest rates go up? The fact is these variables, often more than one variable moves at once. And we have something in this market that I coined reactive supply. It means that if interest rates go up, not only will demand go down, but so will supply of houses. So what it means is that that relationship between supply and demand may not get any better for you. There are a lot of forces, I think, that are very, very heavy forces and hard to overcome. I mean, the kind of interest rate increases that we are going to have to really produce the sort of doomsday bonanza of cheaper prices in the short term, I don't see that existing anytime soon because our supply and demand balance is so out of whack, meaning we have so much more demand than we have supply that it just, the size of the changes that are going to have to occur in the market to change it in the short run. So what happens if you're wrong about this? And we've got a video we've been working on a couple of weeks. It's coming out soon. But if you're wrong about this, where do you end up? You end up in a situation where I think there's a lot more downside risk to waiting than there is upside. That's really what it comes down to. It's not that it's necessary that there's no downside risk to buying now. There absolutely is. I just think it's a much smaller downside risk versus waiting. Anyhow, well, it's Tuesday. That's your Southern California housing market update. Obviously, if you're looking to buy or sell real estate in Southern California, we would love to lend you our expertise and help you with that process. Definitely reach out. There is a link below. Additionally, we do have our new real estate app. We've got a link for that as well on YouTube here. We do not sell your data to third parties, unlike other real estate apps, and our app is just as easy to use and available in the App Store as well as the Google Play Store for Android too. So you can access it either way. We'll put a link for that. Questions, comments, we love them. And do not forget to like, subscribe, and hit that notification bell. We will see you again on Thursday for our architecture email and Friday for our first time buyer market update. As always, like I said, questions and comments, we love them. Keep them coming. And we will talk to you again real soon.